Every trade feels free. A swipe, a confetti burst, a tiny dopamine drip, and suddenly you own a slice of the future. No phone calls, no suits, no oak-paneled offices or crackling landlines. But here, it's the paradox that should make you pause before the next tap. If the broker disappeared, who's paying for the trade? If you aren't the customer anymore, what are you? This is the markets and machines historian, where money, power, and history collide, and nothing is as simple as it looks. The story of zero commission trading is sold as a fairy tale about technology slaying a greedy middleman. In reality, an app didn't just disrupt the broker, it ate the broker, digested the business model, and rebuilt it inside your phone, where it can quietly take a bite out of you, your attention, and your returns. The old world of finance charged you a visible toll called a commission. The new world charges invisible tolls, routing rebates, spread skimming, margin interest, options churn, securities lending, and engagement harvesting. The price is small on each tap, but the meter never sleeps. That's the trick. That's the design. There was a time when broker meant a person. You spoke to someone who knew your name and your risk tolerance. They walked orders to a floor loud with shouts and signals. The price discovery happened in public, messy and human, but visible. Fixed commissions were club rules. Deregulation shattered them. Electronic networks turned shouts into packets, and discount houses undercut the old guard. Then the dot-com era poured gasoline on the fire. Point-and-click trading, banner ads promising speed, research portals that mixed analysis with promotion. Even then, the bargain still felt legible. Pay a fee, get an execution. It wasn't perfect, but the invoice came before the trade. The smartphone changed the psychology and the plumbing. It didn't just make trading mobile, it rewired the economics of brokerage. Zero commission arrived like a liberation anthem. Barriers dropped. Fractional shares meant a few dollars could buy a piece of giants. Teenagers made their first trades from bedrooms and buses. The gatekeeper looked dead. But free is a magic word with a cost hidden in the hat. If commissions vanish, the business must migrate. And it did, into places you can't see on a 5-inch screen. Start with the heartbeat of the free model. Payment for order flow. Your market order, the one you place with a flick, rarely collides with the open market first. It is sold, wholesale, to a specialized dealer who pays the app for the right to fill it. Why would anyone buy your order? Because retail flow is slow, benign, and statistically profitable to trade against. Your broker gets a kickback. You receive something called price improvement, a fraction of a cent better than the public quote. A trophy is placed in your hand, and for a moment, everything seems perfectly aligned. But the quote on your screen is not the battlefield. The true fight is in the spread between the highest bid and the lowest ask, in the midpoint that flickers and hides, in the maker-taker fees that exchanges pay and charge, in the dark pools and alternative venues where orders whisper. If your order never meets a competitive auction, the improvement you celebrate might be better than the worst reference, and still worse than what an open fight could have delivered. Key difference is not dramatic, it is surgical. And surgery, repeated thousands of times across millions of traders, is an industry. That's only the first stream. Margin is the second river flowing through the app's veins. Flip a toggle and your buying power doubles. The pitch sounds like empowerment. The reality is a meter that ticks every day. Financing quietly compounds, during weekends, during holidays, during your sleep. A routine drawdown becomes a margin call that converts a paper loss into an actual sale at the worst possible moment. The app doesn't need you to blow up, it only needs you to borrow. When you do, time works for it and against you. Options are the third act. They look inexpensive and thrilling. A small outlay controls a large exposure. The Greek letters look like a secret language you can learn in an afternoon. Time decay is an unblinking predator. If you turn small tickets often, the pipe earns on flow while the clock earns on you. It isn't a conspiracy. It's a spreadsheet doing exactly what it was designed to do. Securities lending is the part of the business most retail traders never think about. You believe you own a share. In practice, the broker can lend that share to a short seller, pull in a lending fee, and keep most of it. You might receive a sliver if you're in a special program. Usually you don't. The machine does. The picture is complete when you add the scarcest commodity of all, your attention. The app doesn't merely wait for your trade, it trains you to crave one. Color schemes, confetti, streaks, badges, push notifications tuned to volatility. Design becomes a lever for behavior. The broker used to make money when you traded. The app makes more money when you can't stop. Design is not decoration. Design is destiny. A red button can provoke risk-seeking in certain contexts. A swipe reduces deliberation time to a tiny window where impulse outruns analysis. A notification shrinks the horizon from years to minutes. A social feed injects the oldest human drivers, status, shame, the fear of missing out, into a venue where prices move by the second. If you felt the itch to get in when a chart turned vertical, that wasn't an accident. It was product market fit with your dopamine cycle. The test of a model isn't a glossy demo, it's a crisis. When exuberance turned to frenzy and a handful of meme stocks detonated, the plumbing surfaced. Collateral requirements at clearinghouses spiked. The back-end world of net capital rules, margin deposits, and risk waterfalls demanded cash. Some apps restricted buys in the most volatile names, arguing risk controls. The public saw button gray out and smelled betrayal. The invisible architecture didn't care about optics. It cared about survival. Thinly capitalized front ends backed by multi-layered obligations bend under pressure because they must. The old broker was capital heavy and boring. The new one is agile, viral, and thin, until the margin clerk calls. It helps to think of the market as a poker table in a crowded room. Your chips are partly borrowed. The house takes a slice of every pot, whether you win or not. The dealer sees more than you because speed and internalization reveal patterns that retail eyes never notice. The other players are not guessing. They are statistical harvesters playing a different game stacked on top of yours. You can win hands. You can even win big. But the game you think you're playing, buy low, sell high, runs on top of a deeper game. Monetize the flow of orders and the flow of attention. Fairness demands the other half of the story. The app era did open doors. Fractional shares gave small savers access to the world's largest companies. For infrequent long-term investors, the removal of explicit commissions genuinely improves outcomes. Education modules, simplified account opening, and ubiquitous access matter. The on-ramp is real and valuable. That is why the story is seductive. The same tool can be a bridge to ownership or a casino in your pocket. The difference is not only in the user, it is in the incentives of the platform and the design it deploys. Follow the money, not the marketing. If a firm's revenue depends on selling order flow, the product is your order. If the profit engine is margin, the product is your debt. If options are the lifeblood, the product is your churn. If securities lending fattens the bottom line, the product is your shares. If the ad unit is engagement, the product is your time. None of these are crimes. Many of them increase efficiency, but they tilt the table in small, relentless degrees. The old broker needed a commission. The app needs a compulsion. A favorite shield in this world is the phrase, price improvement. You'll see reports boasting that fills were better than the national best quote by a penny. Compared to which yardstick? The displayed quote at that instant? The midpoint inside the spread? An auction across all venues open to all participants? Benchmarks are choices. Choose a forgiving one and everyone looks like a hero. In a fragmented market, prices flicker across venues in milliseconds. The only way to know what you might have received is competition. If your order is sold to a single counterparty before it can compete, you'll never know the price that a real auction could have offered. A penny saved can still be a penny lost if the spread widens just enough to fit the trophy. Complexity is not a bug, it is a feature. App to clearing, broker to central counterparty to wholesaler, to dark pool to exchange. Each hop adds nuance, and each nuance is an opportunity to frame a cost as a savings and a risk as a service. The more tangled the diagram, the smaller the audience that can follow the thread. Camouflage isn't secrecy. Camouflage is jargon layered over incentives. Listen to the human stories, not just the system map. There's the momentum trap, where a notification surfaced a chart already vertical. You bought the top, you sold the dip, the app earned on both routes, and the memory still stings. There's the margin squeeze, where confidence encouraged size. A routine decline triggered a forced liquidation, and the meter charged interest while you waited for clearance to re-enter. There's the options whirlpool, where cheap premiums felt like lottery tickets, time decay did its slow work, and the learning fee was paid in small cuts that never looked dangerous until the account history was plotted. Each story feels personal. Each one is predictable when incentives meet design. If survival is the goal, behavior is the lever. Slow the loop. If an idea cannot survive 24 hours of cooling, it is probably a surge of adrenaline, not a plan. Prefer limit orders to market orders. Price is the lever you control. Separate the accounts that serve different parts of your brain. One for long-term, low-turnover investing that you vow to touch only a few times per year, and another small one for curiosity, so that the itch has a sandbox where losses are tuitioned, not eviction notices. Treat margin like a chainsaw, useful for builders, unforgiving for hobbyists. Count the total cost of activity. Slippage, spread, financing, assignment risk, and attention. None are listed on a receipt. All are real. Align tactics with the true horizon. If you're buying a decade, the minute-by-minute alert stream belongs to someone else's game. Read the routing and revenue disclosures. If they are opaque or nowhere to be found, that silence is itself a data point. The app that ate the broker isn't a historical aberration. Every era finds a way to turn intermediation into software. Bucket shops did it with leverage printed on paper slips. Day trading chat rooms did it with vanity tickers and dial-up latency. Online brokerages in the 1990s did it with blinking banners and fast accounts. The modern mobile platform does it with frictionless touch, behavioral nudge, and a monetization stack that turns each tap into a trickle of cash from multiple directions at once. When a middleman dies, a platform inherits the throne. The crown is paid for by flow. There are defenders of the model who will remind you that spreads have collapsed across decades, that execution quality for retail investors is historically good, that technology has democratized access. They are not wrong. There are critics who argue that internalization siphons vitality from the public markets, that investors are overtrading themselves into underperformance, that platforms gamify risk. They are not wrong either. Both truths can coexist because incentives shape outcomes at the margin, and markets live at the margin. Thin differences compounded by time create thick results. A single penny withheld from a single order is a curiosity. A billion pennies skimmed from a million orders is a business plan. The illusion that died with commissions was not cost, it was clarity. In the old world, the bill was stapled to the trade. In the new world, the costs hide in the plumbing and the psychology. The mechanics hum along whether you notice or not. That's why the story must end where it began, with the question of who pays. Free was never a number. It was a marketing term for a restructured cash flow. Someone still keeps the lights on. If it isn't you, it might be your order, your borrow, your churn, your shares, or your time. So what remains after the analysis peels back the layers? Choice. Not the mythic kind where an individual overturns a system, but the practical kind where a participant refuses to be easy prey for the machine. You can slow your loop and widen your horizon. You can decide that a long-term strategy deserves a quiet corner of your life free from the ping of price. You can demand better routing, clearer disclosures, and genuine competition for your orders. You can remember that every app is a set of incentives printed on glass, and that your habits are the raw material those incentives shape. If you won't shape them, someone else will. It is tempting, after seeing the gears, to swear off markets completely. That is a mistake. Ownership is a cornerstone of autonomy, and public markets remain the cheapest, most accessible path to owning productivity at scale. The point isn't to abandon the table. The point is to sit like a player who knows the rake, the odds and the incentives of the house. The confetti can be fun, so can the charts and the pings and the tiny victories of a well-timed trade. But the engine does not care about your joy. It runs on flow, and your joy is just one way of keeping that flow coming. Politicians will praise democratized finance, and they won't be entirely wrong. Platforms will promise access for all, and they will deliver exactly that. Access and something else. Invisible tolls, smoothed over by delightful design. The broker did not vanish. It dissolved into code and reappeared in your pocket, funded by your taps, sustained by your attention, and quietly compensated by the counterparties who value your predictability. In the old world, you saw the toll booth and decided whether to drive. In the new world, the road is free and the toll is in the asphalt. The app that ate the broker didn't stop there. It nibbed at your patience, your judgment, and, if you let it, your returns. The paradox posed at the start answers itself in the end. If the trade is free, the revenue moved somewhere else. If you aren't the customer, you might be the inventory. But being inventory is not a fixed fate. You can choose the slow path, the quiet account, the limit order, the long horizon, the refusal to chase notifications into volatility. You can accept that the house will always get a slice and still secure your share of the long arc of productivity and profit that markets, for all their flaws, still deliver to patient owners. History has seen every variation of this story. Middlemen reborn as platforms, prices cut to zero, costs resurfacing as complexity, crowds trained to sprint while capital walks. The details shift with technology. The incentives hardly change. Every age needs its translation key. Here's this one. When something gets cheaper on the surface, look underneath for the revenue. When a button gets easier to press, assume someone is betting you'll press it more. When a platform says it removed friction, assume it also removed your pause. There's power in the pause. Use it. Step back from the glow and ask the only question that matters. Who pays, how much, and in what currency? If you can answer that, you've already done the rarest thing in modern finance. You've seen through the design. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.